Joining us now, Kathryn Rooney Vera. She's Chief Investment Strategist at Baltic. So, Kathryn, we got a lot put into that first introduction to you. Let's start with this view of the latest GDP numbers, the latest jobless claim numbers, and what it means for the Fed. Seems to me that stock market bulls want to shrug off anything that suggests what Jonathan Gray is saying is correct, that you're going to get a more tightening Fed than people expect. What do you see?
Kathleen, in an effort to say something different from what many others have said, I'm looking specifically at real wage growth. I think that to determine whether or not we get a recession this year and whether or not the Fed cuts this year, or it's this famous higher for longer, we need to look at the labor market, specifically real wages. Do they flip positive? If they flip positive, then there's a rising chance that the Fed can land this, infamous soft landing, which historically has been elusive when you have inflation above 5% with unemployment rate below 5%. At this point, of course, we have unemployment at near 50-year lows, and inflation is still above 5% with the Fed's target of 2%. So I'm looking at real wages, and I'm looking at an unemployment rate, which I think has to go from 3.5% back up to where I estimate the NARU. Granted, it's an estimate, at about 4.9 to 5%.
So, Kathryn, what do you think in terms of this tech rally? We've had, Microsoft looking at weak demand. We've had Intel looking at weak demand for PCs and having to cut back, really drastically reducing its outlook. What do you think is the trend here?
Yeah, I think it comes full circle. It starts with tech, and of course, tech is one of the sectors that historically underperforms in a stagflation and recessionary environment. I think we're going into recession. We're currently in stagflation, and under that scenario, it doesn't surprise me, and I think we're going to see additional layoffs in the tech sector and in the cyclical sector. More likely than not, this permeates into other segments of society. And as your last guest, I think from Blackstone, mentioned, certainly this starts to take a bite onto what the Fed can do, and how much the Fed can go. The Fed probably does go above 5%, as he mentioned, to get inflation back down to that 2% target. But to do that will likely cause recession and job losses, not just in the tech sector, but like I say, will likely permeate into the broader real economy. And if I'm right on that, we get inflation data out tomorrow, but if I'm right on that, the disinflationary trend gains steam, and under the environment of a rollover in the labor market, the Fed can start to sound slightly more dovish. But I'll finish here, Kathleen. I think the most important thing right now is to realize that year to date, the cyclicals are up. Everybody's playing this mean reversion trade, which is fine, but it's premature. So that's the small caps, it's the emerging market equities, it's the recovery trade before the recession has even occurred.
Kathryn, would you want more international exposure at this point, given that the growth is expected to come out of China, and given that that might actually create a little bit more uncertainty when it comes to the inflation picture too?
Yeah, that's a very good point. The valuations are clearly more attractive. U.S. S&P 500 valuations, I don't think are attractive at this point. I'm remaining defensively positioned here on the U.S. front. And strategically, internationally, I think there will be opportunities. As you mentioned, in China's reopening, that's going to be very important in terms of the eruption of liquidity that could subsequently ensue. But that would, of course, keep inflationary pressures higher. Look, I think you do have to be diversified. I do like some international exposure. I would be wary of select emerging markets, but in general, I think a diversified portfolio, heavily weighted, I would say, maybe not heavily, but I would say increasing your exposure to the fixed income spectrum versus equities, and adding duration to that as we go through the year is my preferred portfolio positioning recommendation for now.
Kathryn, great to have you with us. Kathryn Rooney Vera, Chief Investment Strategist at Baltic.